Street this morning. Top investors watching your money. Joining me now, the Fitz-Gerald Group Principal, Keith Fitz-Gerald, ICAP Chief Investment Officer, Jay Hatfield, and Laffer Tangler Investments Chief Investment Officer, Nancy Tangler. Nancy, I'm going to kick it off with you. We've had a lot of good discussion this morning about markets and the futures, but right now, as you're seeing futures trading higher following yesterday, at least we can say the Dow finished with its fifth straight day of gains. You know, the S&P 500 hit a new all-time high intraday. It did close in the red. It looks like really investors are hoping for the Santa Claus rally, but more importantly, Nancy, it seems that investors are moving past the fears, the initial fears of the spread of the Omicron variant.
Yeah, I think that's right, Cheryl. And I also think, one of the things that we don't pay much attention to is we had a lot of rebalancing from institutional investors that have to go back to their asset allocation, and equities had dramatically outperformed. So some of the estimates were between $1 trillion and $1.4 trillion moving out of equities into bonds just in that mechanical process. But I think as investors begin to look forward, what we know is we probably saw peak GDP growth and peak earnings growth in Q2. We probably saw peak monetary easing in Q3, and we may have seen peak inflation in Q4. So investors will begin to turn their attention back to earnings and economic growth, which, yes, is slowing, but will still be robust. So I think one of the things we need to remember is that a more bearish or hawkish Fed, if you will, is not necessarily going to kill the party. Even if we get the 3 rate hikes that the market is expecting, we still have negative real rates or after inflation yields. So investors are still going to need to be focused on equities with $3.8 trillion in cash on corporate balance sheets, share buybacks at historical highs at $850 billion last quarter. We expect to see companies to continue to put a floor under the market via share buybacks. So we're focused on energy and materials near term as our overweights, and technology as another overweight long term, with a focus especially on cloud, cyber, and the omnipresent semiconductor and semi-cap equipment.
Yeah, and energy prices actually were, energy stocks were actually one of the better performing groups yesterday for the markets. And speaking of energy, let's talk gas prices, Jay. According to Gas Buddy, gas prices are on track to hit a national average of $4 a gallon by Memorial Day. The current national average is $3.28. Drivers have had a little bit of a break over the last few weeks, Jay, but your take on this Gas Buddy report, because it's got a lot of heads turning this morning, and not in a good way.
Well, that's consistent with our forecast. We're forecasting oil prices go to 80 to 100 next year, which would translate into gasoline prices hitting almost $4. And the real critical dynamic there that a lot of investors in the U.S. haven't focused on is the failed energy transition in Europe. They failed to procure enough natural gas. So natural gas in Europe is trading 9 times or 900% higher than in the U.S. at the oil equivalent of $200 a barrel, which if that was happening in the U.S., the political backlash would be enormous. We think there'll be some in Europe. But so that's a critical tailwind for all energy, because there's a substitution effect where people are trying to substitute oil, coal, or any other energy source to try to bring down those prices. Because keep in mind that drives up electricity prices as well. And it also, by the way, makes the U.S. economy very competitive. So we're relatively bullish about both the economy for the U.S., but unfortunately for consumers, we don't disagree with gasoline prices going to $4.
Well, gasoline is a real inflation. I know that the reports are split up, and you strip out, food prices and energy prices when we get those government reports. But this is the real story, is food and it is energy, Keith. And I think that's Jay. Excuse me. And I think that that's the real concern here is that businesses aren't getting a break, and that is going to be the economic slowdown. That we're already seeing it. We've been seeing it for 2 months now.
Well, no doubt there is a risk. The Fed is going to tighten, and keep in mind that the Fed has tightened and caused really all of the post-World War II recessions, all 11 of them. But there is a distinction between this year, 2022, and 2018, for instance, in that we don't expect the Fed to do quantitative tightening. So they'll stop quantitative easing. But keep in mind, in 2018, they were shrinking the balance sheet. And that's really a disaster for investors because equity risk premiums, not just interest rates, but the total return required by investors increases. And that's why you've seen some backup in tech stocks and riskier stocks because of rising equity risk premiums. But we don't think the disaster scenario is going to happen where the Fed tightens or reduces the balance sheet, does quantitative tightening. And so we're relatively constructive about next year, despite the fact the Fed is going to be reducing liquidity.
And for the markets, the Fed has been very transparent, the most I think I've ever seen in 20 years of covering the Fed. Keith, I want to bring you in here. President Biden is reportedly eyeing Sarah Bloom Raskin for a top role at the Federal Reserve. We were just talking about that with Jay. The administration is considering Raskin, a former Fed governor, former Treasury Department official, to be vice chairwoman of supervision. This is the top overseer of the U.S. banking industry. So, Keith, what do you make of the regulatory backdrop? I know you like J.P. Morgan as a stock, but first talk about this potential pick for the Federal Reserve and what that means for the banks.
Well, call me crazy, Cheryl, but why don't they take somebody that's got actual banking experience who's going to be in charge of regulating banks? This is something that drives me bananas inside the Beltway. This is like asking a heart surgeon to regulate high tech or a high tech executive to regulate kitchen cuisine. This is not appropriate for the financial system as it exists today. That said, I think the market's going to deal with it. I think the market is going to move forward, but it's a progressive choice. It's clearly, in my mind, politicized.
Yeah, good analogy, by the way. That was funny, Keith. Really quick, Keith, I got to ask you before you go, we do have bank earnings coming up. Believe it or not, we're about 3 weeks away. So what are you forecasting?
Well, I actually think the numbers are going to be really good. I think that what we're going to see is all of the consumer spend, the Visa, the transaction data, all of that's going to play into the banks. I think they're a logical choice as we come into a higher rate environment because their margins expand. Typically, profits go with it. But, Jay and Nancy are totally onto this. It's fundamental supply and demand. Great companies at an interesting time in history are going to continue to charge forward. So if the banks have good numbers, that sets the stage for what I think could be a strong entry into 2022.
Well, that would be good to see. Definitely. I'm not going to disagree with you there. Keith Fitz-Gerald, Jay Hatfield. Guys, thank you very much to you. Nancy Tangler, stay with us. You're going to, of course, be with us for the rest of the show.
Hi, it's Keith here. Thanks for checking out today's highlight clip. What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below. And, of course, click subscribe to keep up right here on YouTube, or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.